Hello. Good afternoon, ladies and gentlemen. Welcome to our panel discussion. The title is basically, the hard part is over, right? Asia's time has arrived. So once again, I'm Edward from UOB Asset Management. I will be the moderator for this session. We are here, to explore the promising outlook of Asian markets in 2024, okay? So we had a challenging year in 2023, but I think, it seems that Asia is poised for, significant turnaround with rates hike probably behind us, rate cuts on the horizons. And our focus today will be on the opportunities and risks in Asia, equity, as well as, tactical plays in the high-yield bond markets as well. So I'm thrilled to introduce our esteemed panelists. So we have Colin, right? He's actually our head of Asia equities. We have Melvin. He actually manages the high-yield portfolio, fixed income Asia. So their expertise in this field is unparalleled, and they are here. We are fortunate to have them here to share their insights with us today. So without further ado, let me just dive in, right? So 2023 was a year of global economic challenges, and Asia was no exception, I think. So, however, there's a growing belief that, Asia is uniquely positioned to outperform. So, Colin, as the head of Asia equities, probably could you share with all of us your perspectives why Asia is at this turning point, especially with the recent shift from rate hikes to potential rate cuts? Yeah, Colin.
Yeah, thanks. Good afternoon, everyone. On behalf of the management of UOB Asset Management, I would like to greet everyone a happy and prosperous New Year. And next month will be an early, 𝗪𝘃𝗀𝘁 Chinese New Year. So I just want to highlight that for last year has been a challenge for the market because the investors were very focused on US inflation. Inflation in the developed markets. That said, what we have saw over the last, I would say last 2 months was that inflationary data from US seems to have, have peaked and subsided, and that allowed the central bank in US to probably cut rates, in the later half of this year. So we are talking about, market is expecting at least 4 rate cuts. That certainly will be a good point, a plus point for Asian equities. Okay, I just want to highlight basically 3 main points why Asia, the worst is behind us. Going forward in 2024, things are likely to be better for Asia than compared to last year. If you look at the forecast in terms of economic forecast as shown on the charts here is that, we are likely to meet in terms of GDP growth, 4.6% for Asia Pacific. China likely to grow 5.2% last year, but however, going forward, likely to grow just 4.5%. That is our forecast. The point here I just want to make here is that across the markets that we are seeing, there are certainly a lot more markets are growing a lot more stronger than we see than last year. So therefore, if you think of it that way, is that one, given that interest rate is likely to come off, US dollar could be weaker, and that should be positive for Asian equities. And as you can see over here is that, in terms of economic growth, you look across all the various Asian markets, seems to be a tad more stronger than what we saw last year. So that certainly will be a plus point for Asian equities. If you look at the valuation, unfortunately for last year is that Asian equities hasn't really performed. Why is that so? Is because I think investors are very nervous about US interest rate hike. Once this so-called concern is elevated, then investors can focus back to emerging markets again. And here, if you look at valuation for Asian equities, seems to suggest that we look at Southeast Asia is at the low point of its valuation band over its historical valuation band. If you look at markets in China and Hong Kong, they are still struggling. no, I think briefly is that we look forward to a stronger second half for China equities, when, when we really see interest rate being cut. Aside from that, I think other markets that is probably also interesting is the ASEAN, because markets like Indonesia, Malaysia, Singapore are at the low end of its valuation band. So, as I said, with interest rate on the macro backdrop, US interest rate likely to decline, from the second half of this year, that will allow markets like Asia to probably perform better in the second half.
Wow, okay, so thanks for that insightful perspective. So I think the following questions probably, so in what you have explained in the light of these macroeconomic shifts, what sectors do you think will lead the charge in Asia for this year?
Okay, to me is that you want to look for, given that as I earlier explained to all of you all, is that growth will be stronger because of likely to be stronger, and that encouraged by interest rate cuts. Then you want to be in some of the cyclical growth sectors, like consumer discretionary, like technology, for example. But I think for investors that are looking for secular growth, like what we are also looking out for, is that still look for example, renewable energy space, where we talk about EVs, solar panels, wind turbine energy. That will be a source of growth, a secular trend of growth, for multi-years to come. So, at this point here is that we are beginning to see in Singapore, for example, some EV cars, still not a lot, but it's actually in a transition point. I think elsewhere in China, for example, EVs represent at least 35% of sales right now. So, that trend will actually continue not only in China, but in Europe as well as the US. I think this trend is really unstoppable. The second area is in the area of investment technology. I think we all talk about AI applications. Likewise, we are looking for companies that are beginning to push this AI applications, to affect, the quality of life and future going forward. In the third area, we look at also 6G technology. Why I say that is because it's all interrelated. With 6G technology, I think that will push up autonomous driving, and that will also link with your EV cars as well. So all these are all investing for the future technology. And certainly, I think investors at this moment in time are still looking out for a lot of these meaningful stocks for investing in the future. I think near term is that given that growth are likely to be a tick stronger, I think it's safe to be investing in some of the consumer discretionary cyclical stocks for some upside this year. Thank you.
Okay, I think that's quite impressive in terms of his answer. Yeah, I think EV-wise, like what you say is actually quite true. In China, they probably have the whole supply chain in the same geographical area, and that also actually kind of helps in their maintaining the economy of scales in producing EV vehicles at a low production, so on and so forth. So all these upcoming trends are probably very evident in Asia, and I think in terms of Asia equity, that's where people could actually pick up opportunities in, right? But of course, we also have our Asia portfolio manager over here. So I think turning to the bond market, basically, I think last year was actually quite a good market for the bonds. But as an Asian high-yield portfolio manager, Asian high-yield has been something like a taboo for a lot of the investors out there, given what they have actually experienced. But what opportunities do you actually foresee in the space for 2024? I think we probably be seeing a turnaround. And how should investors basically approach these opportunities, especially considering the current economic climate? Yeah, Melvin, thanks.
Okay, thank you, Edward. So for 2024, with expected rates cut coming, I think it's really a perfect time to invest in the Asia high yield market. The Asia high yield is currently giving about mid 14+% yield, versus the Asia investment grade of 5+% yield. And what does that mean for investors? It means that there's so much more value in Asia high yield compared to Asia investment grade. And if we were to expect an interest rate cut, that would mean spread tightening, or rather capital gain if you capture the yield right now. Okay. Secondly, Asia high yield default rate has been coming down from its peak in 2021, 2022 during the China high yield property blow up. 2023 has been lower, and 2024 is expected to be even lower. That will mean more stability in the Asia high yield bond market. As for opportunities, for us in UOBAM, we think that it's still early to hop on into China high yield property, because even with the government measures, we don't think that the physical market has improved. But that said, this is near the worst already, and we have identified some China high yield property names, that better quality names, that we may enter when we see an improvement in the market. Aside from China property, there's also a lot of opportunities elsewhere. This is due to increased Chinese spending, infrastructure, and tourism ever since COVID lockdown was lifted. For example, in Macau gaming, we have seen very, very strong Macau gaming revenues from Chinese tourists mainly, and that's one bright spot. Even emerging economies like Pakistan, Sri Lanka, Mongolia, ever since the lifting of the lockdown, we have seen increased infrastructure spending, IMF spending, and even a freer export-import trade. Yeah, so these are some opportunities. And finally, in India, India is expected to be the top 3 economies in the world going forward. And for the high yield space, it provides a lot of opportunity. The largest sector is in India renewables. And we think that renewable is a space that not only Asian investors like, but global investors like, due to the focus of environmentally clean company. Thank you.
Okay, so yeah, that's a great comprehensive answer. And of course, one of the questions I always have in mind is that, of course, like what Colin have mentioned, rate cuts are anticipated, probably 4 rate cuts, but there is always this possibility that, of unexpected shift in the monetary policy. So how would a sudden, shift in interest rate policy, say a reversal to rate hikes, right, affect your high yield bond strategy that you're managing? Maybe you can share with the investors.
Okay, the simple answer is it will not change much. I think since last year, we have been positioned for a higher for longer regime. What does a higher for longer regime means? That means for the Asia high yield market, companies will find it harder to come out because refinancing costs are high. And if there's an interest rate cut, it's very good for the market, it's a bonus. But that is not our base case. So how do we position in such a market? We have a 60-40% approach, where 60% are invested into very good quality high yield names, as well as short-dated high yield names that we, after doing our bottom-up research, we think that the refinancing capabilities are very strong. 40% is for tactical allocation. So what do you mean also? So last year, we invested in Macau gaming during the bottom because we feel that China will reopen one day, right? And even if China don't reopen, the US parents will support them. And this has helped our portfolio so much. Yeah. So with this 60-40%, the key is to invest in very good quality company, be defensive. But if the market rally, we can still participate in some of these gains. Yep, thank you.
Okay, wow, then there you go. He has the expertise to manage that on all this. So I think one thing is that the outlook seems optimistic, but I think it's also important to discuss the risk, right? So, I mean, there will be risks still looming in the year. So what are the key risks investors should be aware, in both Asian equities and also in the Asia high yield bonds in the coming year? So probably, Colin, you want to go first?
I think in terms of risks, I just want to highlight that I think over the last, especially over the last 3-4 years, we saw a bit more geopolitical tension between US and China. And that has developed into a trade war, recently a tech war as well. I think that has been, somewhat disruptive to the economies. Of course, there are beneficiaries and those that are, I would say, negatively impacted. I think in terms of beneficiaries are those, for example, countries that benefited from the outsourcing or diversification away from China. On the other hand, if you just focus on China, is that unfortunately China is really a huge part of Asia. The thing is that especially over the last 1-2 years, if you read your Straits Times, for example, or any media, they tend to be very negative on China economy. I just want to highlight that I just went to Guangzhou during the December holidays. I think for Singaporeans, we would like to go and look around. And the fact is that when I travel on the high-speed rail from Hong Kong to Guangzhou, I can really understand the efficiency of actually investing into infrastructure in China. And right now, I think over the last 15 years, when I first covered China, was that they started off with all this building of infrastructure network, high-speed rail. And right now is that it is by far the largest high-speed rail network in the world. And unfortunately, the market, Chinese market still suffer. Basically, in terms of the market falling over 3 consecutive years. I'm not saying that the Chinese market itself actually looked ripe for a rebound. But however, because of all these negative news flows, things are likely to be probably delayed until the second half of this year. But that said, if you look for longer term, if you want to be more convinced, do travel to China and take a look for yourself. Indeed, business has been affected because of the property market. But if you look at the infrastructure itself, China, if those who have listened to what Chinese president has spoken over the new year, on his speech, is that you do understand that they are looking for quality growth, development of quality growth, and that is basically, looking at your EVs, for example. If you all probably read, BYD has actually overtaken Tesla as the largest EV seller in the world. And not only that, is that China has developed, for example, commercial vehicle. The C919 is a competitor to just Airbus and Boeing. So indeed, there is actually a lot of development. But that is the risk for China, for Asia right now.
Yep. Yeah. How about Melvin?
Okay, so one of the key risks is what you mentioned earlier about a reversal in monetary policy, which I've addressed. Another key risk would be a change in China policy. China only accounts for 26% of the benchmark or the market right now versus last time, but their policy will impact the whole of Southeast Asia. For example, like I said earlier, when they reopen, everything benefit. Mongolia, Pakistan, everything benefited. Macau gaming benefited. The same thing for China policy. When they reversed the policy, there was a huge crash. So a sudden shift in policy like that again will impact the market incredibly. That's one thing. Secondly, for India, as I mentioned, there's a lot of opportunities there, but everybody is thinking the same thing as well. So India renewable is very expensive right now, but the sector is also very new. There's not been any stress or distress born, but never say never. That said, we don't think that all these risks will likely to happen in the short to medium term for now. Yeah.
Okay, so thank you for the answers. So I think one thing is that, we in UOBAM, when we talk about Asia equities, when we talk about Asia high yield, we do have the funds. We do have the solutions for the investors out there. So our United Asia Fund is basically a 4-star Morningstar fund. What is really interesting that, we really actually perform. We have actually outperformed our peers in the category. We have outperformed the index. So I think one thing is really interesting about the United Asia Fund is also that in the investment process, we actually implement AI ML to, or artificial intelligence and machine learning. We use big data basically to, sieve out the gems in Asia, and we actually invest with, fundamental analysis. And basically, Colin's team is the one managing the United Asia Fund. So if you want to know more about this, please do visit our booth. Our booth is just right there. And also, of course, you can have some funds with it in it as well. And the other one is basically our United Asian High Yield Bond Fund. Relatively good performance compared to the peers. In fact, last year, I think we were one of the only one that was actually positive in the Asian high yield space. And one of the things, like what Melvin actually mentioned, there are risks, right? But what is key and what is basically our competitive advantage is that our credit selection criteria is very strict. The credit selection basically help us in navigating the risk and, of course, and amplifying the opportunity. And that's basically what Melvin has basically been doing. So I think that it has been evident in our funds performances as well. So within the category, we actually outperform the category in the peers, as well as the benchmark as well. So please come to our booth, know more about the funds, and I really thank you for the attention. And so I hope everyone have a good 2024, and yeah, let's see how all this plays out for the year, but I think Asia looks fantastic for the year. Thank you.